Asset Management and Pooled Investments examines the structure and functions of the asset management industry within the program. Asset management firms manage investment portfolios on behalf of individuals, institutions, pension funds, foundations, insurance companies, and other clients. These firms are considered buy-side participants because they invest capital rather than facilitate securities issuance or trading like sell-side institutions. Asset managers may operate independently or as divisions within larger financial services organizations. The industry includes both traditional managers focused on equities and fixed income securities and alternative managers specializing in hedge funds, private equity, commodities, and real assets. Asset management plays a critical role in global capital allocation and long-term wealth creation. The topic distinguishes between active and passive management approaches. Active management seeks to outperform a chosen benchmark through security selection, market timing, economic analysis, or specialized investment strategies. Active managers attempt to exploit perceived market inefficiencies and generate excess returns known as alpha. Passive management, in contrast, aims to replicate the performance of a benchmark index rather than outperform it. Passive strategies may involve traditional index tracking or smart beta approaches emphasizing exposure to certain risk factors. Passive investing has grown substantially because of its lower fees and evidence suggesting many active managers struggle to consistently outperform markets after costs. The distinction between active and passive management significantly influences portfolio construction and industry competition. Asset management firms may also be categorized according to investment specialization. Full-service asset managers offer multiple asset classes and investment styles, while specialist firms focus on specific sectors, strategies, or asset classes. Multi-boutique organizations own several specialized investment managers operating independently under a broader holding structure. Traditional managers generally concentrate on publicly traded stocks and bonds, whereas alternative managers focus on private equity, hedge funds, real estate, infrastructure, or commodities. Profit margins within alternative asset management are often higher because these products involve greater complexity and higher fees. As investor demand for diversification and alternative strategies has increased, many traditional firms have expanded into alternative investments, blurring distinctions across segments of the industry. The topic also discusses pooled investment vehicles, which allow multiple investors to combine capital into professionally managed portfolios. Common pooled investments include mutual funds, exchange-traded funds, ETFs, hedge funds, and private equity funds. Open-end mutual funds issue and redeem shares directly with investors at net asset value, while ETFs trade on exchanges like stocks and generally offer greater liquidity and lower expense ratios. Hedge funds are lightly regulated private pooled investments available primarily to qualified investors. Private equity and venture capital funds invest directly in companies and often take active management roles. Pooled investments provide diversification, professional management, economies of scale, and access to investment opportunities that may otherwise be difficult for individual investors to obtain. Separately managed accounts represent another important investment structure discussed in the topic. Unlike pooled funds, separately managed accounts are owned entirely by a single investor and customized according to individual preferences, constraints, and objectives. Investors maintain direct ownership of securities while delegating portfolio management responsibilities to professional managers. Separately managed accounts offer greater flexibility regarding tax management, investment restrictions, and portfolio customization. However, they generally require larger minimum investment amounts than pooled vehicles. Institutional investors and high-net-worth individuals often use separately managed accounts to achieve tailored exposure while maintaining greater transparency and control over portfolio holdings compared with commingled investment structures. Overall, topic demonstrates that asset management and pooled investments are essential components of modern financial markets and portfolio management. Asset managers allocate capital across global markets using active or passive strategies designed to meet diverse investor objectives. Pooled investment vehicles provide diversification, professional expertise, operational efficiency, and access to specialized markets for both institutional and retail investors. At the same time, investors must carefully evaluate differences in fees, liquidity, transparency, regulatory oversight, and investment strategies when selecting among available investment structures. For CFA candidates, understanding asset management organizations and pooled investments is fundamental because these entities dominate global investment activity and form the operational framework for professional portfolio management worldwide.